Hi. Welcome to the session on how Dataiku can streamline asset-level physical climate risk analysis. There we go. My name is Valentine Reltian. I'm Dataiku's consultant in AI solutions for sustainability, which means I help organizations leverage Dataiku to better harness their environmental impact, climate risk, and opportunity data alongside their financial and business operational data to drive value. My personal goal is to help progress ESG analytics away from a hamster wheel cost center of compliance towards a value-generating work stream for innovation, competitiveness, and resilience. Today, I'm coming to you with a pitch of how to solve a common problem we see our clients facing. And I invite you to chime in at any points with questions, challenges, to share experience, you name it. I'll start off by setting the scene around the stakes and challenges that this exercise typically implies before sharing with you our proposed approach with Dataiku and, time permitting, a sneak peek into what is coming next as the next project. But before I go there, I would like to kind of do a show of hands to ask you about your take on the question you see on the screen. At present, what is the proportion of London's commercial real estate that is at severe risk of flooding? Could I get a show of hands for those of you who back 5%? Those of you who back 15%? Those of you who back 40%? Yeah, climate change is getting really personal. Aviva published a study last week that showed that 40% of all London's commercial real estate is presently at severe risk of flooding. And that is just the beginning of it, considering the trajectory of exponential climate crisis we are on. Come 2050, projections show that some of London's boroughs are going to be facing 92% of severe risk from flooding, which is spelling out uninsurability. And these are places that we live in, that we work in. In particular, the two boroughs of London are Old Southwark and Bermondsey. And this really comes to challenge a preconceived notion that the climate crisis is a problem for polar bears, Pacific Islanders, and future generations. Not least because flash flooding, or any types of flooding that the UK is vulnerable to, is really just the tip of the iceberg of the challenges brought on by the climate crisis. You'll forgive my pun. To put that into further context still, last year, Munich Re determined that the climate crisis led to $140 billion in insured losses, which pales in comparison to the non-insured losses, the $1.5 trillion in economic damage in the decade coming up to 2019. Again, this is quite likely going to be the least expensive decade of the century, given the nonlinear exponential nature of the climate crisis. However, these risks can be anticipated, and they can be managed profitably. There is a very compelling business case for anticipating and tackling the root cause of the climate crisis, as well as preemptively adapting to its effects. Consistently, this strategy beats inaction and reactive recovery. In fact, the Potsdam Institute for Research in the Climate Impact demonstrated that come 2050, on a very conservative trajectory for the climate change space, it is likely that the annual damages of the climate crisis are going to be 5 times higher those of abatement, so those of tackling the root cause of pollution. And BCG, when analyzing the results from its adaptation investments, showed that every dollar invested in climate adaptation measures returned between $2 and $15 in return. And so that positions us staunchly to handle this situation collectively. Now, you may be wondering, if this is the case, why have we been so slow to tackle the climate crisis? And second of all, is there a way that we could accelerate it? Our tackling, I mean. Now, I don't have all the answers, and I'm not telling you what to do. I'm neither an economist nor a Nobel Prize winner. However, if you're asking yourselves these questions, you're in luck, because so have I, and that's what I'm going to be sharing with you now. So, Some view that rising to the occasion of achieving the opportunities underlying climate risks is essentially a matter of redirecting and unlocking financial flows. So it's worth considering why the financial markets have been so slow to tackle the climate crisis to begin with. Abstracting from obvious political drivers, I suggest we look at a very simplified representation of what, on paper, weighs into traditional capital allocation decision-making. In business as usual, the financial sector and insurance, or FSI from here on out, are essentially looking for evidence that whatever they invest in is not going to lead to a loss of capital, but instead is going to lead to a growth of capital. And so businesses are expected to provide evidence to that effect, typically contained in your typical financial documentation. However, as with many things, the climate crisis is shaking things up. As extreme weather is becoming ever more frequent, intense, and destructive, simply relocating your operations, disinvesting from certain sectors, or in fact shrinking your market coverage is no longer going to protect you from the effects of the climate crisis, given global supply chains and markets all around the world are now affected. So what's interesting, though, is that increasingly, to determine the real-world soundness of an investment, financial sector actors and insurers are looking to find proof that their assets have conducted granular climate vulnerability assessments and have taken commensurate action to tackle those risks, which has now real-world and very financially material repercussions on businesses' competitiveness and resilience, given capital and insurance providers are asking for higher returns for their taking on higher risk linked to their assets' either lack of adaptation, lack of mitigation, or maladaptation, for that matter. Which means that climate risk management, once considered a nice-to-have reserved to corporate sustainability, is now becoming a proxy for sound corporate governance, business continuity, and critically, corporate valuation. Which is also to say, therefore, that investing in climate adaptation, resilience, and mitigation measures is now becoming a matter of strategic capital allocation, no longer merely virtue signaling. It is really striking to hear a sense of urgency arise within the financial sector and insurance spaces, especially insurance, now that the very real risk of global uninsurability is looming on the not-so-distant horizon. And at the same time, we're also hearing a very real hunger to activate their levers to drive solutions. But there's a limit to how much they can do on behalf of their clients. And there's also a recognition of a critical gap between, on the one side, their needs for very granular, robust, asset-level data around climate vulnerability, and also tangible plans for climate adaptation and mitigation, to demonstrate that the businesses are genuinely getting ready and recognizing that we are in the new era of the climate crisis. And then on the other side, you've got businesses who are slow to provide this new level of data, not because they are unwilling, but because they themselves are struggling with competing short-term priorities, struggling also with political and regulatory uncertainty, and also have lagging technical capacity to deliver this data at speed and scale. Which now begs the question of how can we help bridge this gap? Because that's what we're seeing now, is the need to operate three shifts, we argue, on a couple dimensions. The first is the need to move away from aggregated estimates around these matters that really cloud decision-useful insights, and to move towards asset-specific data. The second is to move away from static, descriptive risk exposure analyses that sure tell you that you've got a problem, but they don't tell you what to do about that problem. And so we're now needing to move to future-looking, operationalizable action plans that illustrate how specific investments in adaptation and risk measures, so say you've got nature-based measures like investing in vegetation buffer strips to combat surface flooding, or district cooling. Equally, you've got more so tech-based measures, say like finding substitutes to clinker. That's a very polluting cement material, or even early warning systems for increased preparedness, and showing how specific investments in those measures can actually result in tackling the underlying risk. And overall, there is a need to upgrade from siloed ESG analytics towards metrics that are brought on par with financial KPIs so that these can be embedded, injected within decision-making, within credit risk analysis, within operational risk analysis, and so on. So now, what I'm going to show you is how Dataiku can help operate this first shift from aggregated estimates towards very asset-specific climate vulnerability forecasts. And time permitting, I might share where we're going next, and I have faith, let's say. So we positioned ourselves as a cement manufacturer's risk manager who's trying to understand how their production facilities worldwide are likely to be impacted by climate risk. And is this? Sorry, I'm just checking whether it's, nope. Is the video, okay. Sorry, I'll just describe. You're gonna see an illustration on the screen, but I think it was just a little bit locked. Cool. Right, that climate risk manager is trying to figure out the production. It's working, excellent. Nice. So we used asset data that we sourced from the open source library Climate Trace that provides over 6 million satellite observations of industrial assets across the world on a monthly basis. And we started by leveraging our visual recipes to prepare that data, to clean it, standardize it, verify its quality to ensure it is fit for purpose, to then serve as the input into a custom-built plugin Q that interfaces the FizRisk calculation engine that does bottom-up calculations of assets' future exposure to climate hazards based on your assets' geolocations. And the plugin lets the user visually configure the climate risk analysis by submitting the timeframes as well as the future model or scenarios. And critically, it also lets the user visually configure the vulnerability function by specifying the asset class and type, which allows for a specific function to translate the hazard exposure into a forecasted impact on the asset as a function of damage to the asset's insurable value or as disruption to its activity. The results are then unpacked, cleaned, further processed, so that they are then ready to be consolidated in our visual dashboard. The dashboard starts with a summary representation of the analysis, providing a breakdown of the portfolio composition, as well as a historical baseline for asset exposure to climate risk and damage. We've also, to enhance the user experience, included an answers interface to allow for the user to ask any specific question that may arise for them as they're engaging in the analysis. And this interface is a curated knowledge bank that is composed of the FizRisk methodology, as well as specific impact assessments on the cement manufacturing's vulnerability to the climate risks. Next, we've got a little example here of the type of questions that they may ask. Next, there's a side-by-side comparative analysis of the forecasted impacts based off the two shared socioeconomic pathways, which are these future scenarios. And you have a portfolio-wide view with these stacked bars representing the percentage of damage or disruption that the insured that the insurable value of the portfolio is likely to be, how it's likely to be impacted, as well as a geographical representation and then an asset level breakdown. And this asset level breakdown is then further detailed in our third slide that basically provides a visual representation of the distribution of probabilities around the functions of vulnerability that you've just ran through. And this is really important because otherwise that information is just synthesized in your mean impact that you see at the top there. And so here you get to have an understanding of the uncertainty that is normal when you're dealing with probabilities, right? And eventually we've also added another answers interface that I hope I'm not making you seasick with these videos. Another answers interface, because we know that it's common for users to have questions around the underlying functions in the space. And so in this way, you have all you need in one and enhanced decision-making and sense-making support. What I want you to take away with this is that in this one project, we can conduct a bottom-up hazard exposure and vulnerability impact analysis at the portfolio as well as at the asset-specific level. And thanks to the modularity of the project and the reusability of the various preparation pipelines, you can always include more and new data sources around climate risk as they become available, as well as change around the function of the vulnerability so that it is specific to yours that you have modeled yourself, but you are able, by going in the behind the scenes of the plugin, able to test out these different ones and do so at speed and at scale, thanks to the reusability of it. The project is also now going to be available for critical review of your colleagues. And most importantly, the data, while already packaged within a dashboard for sense-making support, is also preserved and ready to be reused in subsequent projects. Essentially, this mean impact that you'll have extracted can be the seed of your cost of inaction, which I will get back to. So. Right, so that I've mentioned this. And indeed, now you've got this project that can help you accelerate your pace from trying to understand what the risk is you are facing towards how can you buckle down into the solutions that help you avoid the risk, but critically achieve the opportunities that are always the flip side of your risk. So I'll pause here, because I appreciate that this might be a lot of information, and I would like to open some space for questions or feedback or experience. First of all, I'm quite interested whether anyone here is already engaged in climate risk analysis or of the reuse of this type of analysis within your operations. I see a slow nod. Not really? Okay, yeah, well, I actually also just realized that we don't have mics, so sorry about that. Cliffhanger. Right, so as a result, time permitting, time permits. I'm now going to share with you what's next on our roadmap. And this is the part that I'm personally most excited about, not least because I'm going to be sharing with you just the skeleton of the agentic flow that we are now building to follow through on this analysis. So I'm sure you'll have heard all about Dataku's agentic capabilities, and that's not what I'm going to be sharing about today, but more so just sharing with you our vision for the next steps. And the reason why we're moving towards an agentic flow with this is because without that, this would be an exercise that would be too onerous in terms of time, capacity, and resource if you wanted to conduct it one asset at a time, whereas an agentic flow actually allows for this type of project to lift off the ground. So once we've conducted our climate risk analysis, we're going to then convert that mean impact into a financial cost, the cost of inaction, provided a function that is at the user's discretion. And then we're going to be using this context for the climate risk analysis as an input to retrieve information about best practices around climate adaptation, resilience, and mitigation from a knowledge bank that we will have curated, and asked for the response to be brought back into a very specific format so that we can then connect that, match it with our adaptation, resilience, and mitigation lever library. So I've mentioned a couple of what those levers would look like earlier, your nature-based solutions, your tech-based solutions. And thanks to our LLM capabilities on Dataiku, we were able to enhance data preparation of these libraries that are basically composed of a combination of structured and unstructured data, which is very difficult to work with and to prepare in particular. But thanks to our LLM-based preparation stages, this is something that we were able to do, which means we now have a functional library that's composed of both our levers, but also quantitative information around those levers' costs, their expected impact, their lifetime, and so on. Having then matched the specific levers and retrieved that information, we can then run an evaluation of the return on investment of those levers, as well as a return on resilience investment, or as some of the climate adaptation and mitigation geeks in the room, if I have any fellows, perhaps not, that's fine. We call it Rory. Anyways, that's just, I'm excited about that. And finally, then, all of that information can then be consolidated automatically within a decision-making support that is then ready to be shared for the other stakeholders in the project. Right, okay, so now that I've shared that with you, I want to thank you for your time. I would really want to open to questions, so please just come to me if that is something that you would like to discuss further. Thank you so much for your attention and have the great rest of your time. Cheers.